Exciting couple of sessions on digital economy and big data now that will get underway. And we have some speakers who will take us through the topic that is occupying the mind space of the OECD, of the G20, of so many other countries, some of whom, as Amay said earlier this morning, are enacting some unilateral measures. The one sentence which has literally captured everyone's attention is the line, data is the new oil. And I think big data is probably the big elephant in the room as far as international taxation is concerned today. If you look at what exactly is bothering the policy makers the world over, you look at the news digest we put out every day in the afternoon at 2 p.m. at Taxsutra, one of the headlines invariably every day is about some press report on digital economy taxation. So that's how much this issue is occupying the mind space of the policymakers from the OECD or from the G20 downwards. Will a solution be elusive or is a solution imminent? We do not know. And if we do have a solution, what exactly that solution will be? I think Jeff would have given a sneak peek in the morning. He did say that whatever be the solution, we are going to have further offshoots of that and impact and consequence of that for not just the digital economy, but for the rest of the economy as well. I think that gives a very good hint at what the policymakers are thinking, and it also gives us probably something to mull over, that whatever is the solution on digital economy, I think the OECD will have to think it over, the countries will have to think it over, because the repercussion is going to be felt quite wide, apart from just the digital economy itself. We have a session on big data now, and I wouldn't like to talk much on what is big data. We have Kunj to do that for us. But before we begin the session on big data, PwC is releasing a very a unique paper, Big Data, a Transfer Pricing Perspective. And just to give you a brief outline of what this paper is, I think digital businesses have grown exponentially over the last year or so. Someone said that out of the top 20 businesses in the world today, 7 or 10 of them have actually been born after 2000. So that's exactly how much the business landscape has also changed in favor of digital businesses. And therefore, the perceived gap in the taxation framework, a significant physical presence in a market is no longer required to create value from its big data. This has challenged the existing international tax framework, as corporate taxation has historically been based on physical presence in the market. The perceived gap in the taxation framework has been discussed in detail over the last 3 years or so, and is now sought to be addressed through multilateral efforts by the OECD, EU, as well as unilateral actions by various countries, including the UK and India. And just a couple of lines on the white paper. This white paper discusses the application of transfer pricing principles to determine income attributable to a digital presence, that is the SEP in a source country. We've had a significant economic presence legislated in India as well, Kunj, and this is going to be a fascinating session. Before we embark on the session, before I introduce our speakers for the session, I'd request Jeff Vanderwolf, Jeff, to please release this white paper. Kunj would present the first copy of the white paper, Big Data, a Transfer Pricing Perspective, to Jeff. Jeff, please do the honors for us.
Jeff seems to already have a copy.
Yes. Thank you.
That is what OECD always has things before we do. Thank you so much, Jeff, really. This is a white paper on big data that Arun just talked about. We are very, very proud to release this today. It's thought process and it's a journey. So it's not an end in itself. Don't look for answers. We would be very much more proud if this adds to and as a contribution to the journey that we all across the world are walking towards on defining these new paradigms that we have. My colleagues are here who have strongly contributed on this paper across the country as well. So thank you so much. The hard copies will be available tomorrow. We will be sending out soft copies. Jeff, thank you so much. Really appreciate it.
Thank you very much.
Yeah, Jeff, could you just hold it up? Yeah.
Thank you.
Thanks. And
Thanks a lot, Jeff.
it's a pleasure to introduce the speakers for this session. We have Kunj from PwC, Kunj Vaidya, Darpan Mehta, and Jitendra Jain. I'll quickly introduce Kunj, who will lead the session. Kunj is the National Transfer Pricing Leader. at PwC India. He's more than 16 years of experience in providing quantitative and strategic analysis to companies interested in establishing pricing policies. This includes providing assistance in accordance with transfer pricing requirements in USA, Australia, and India. His area of focus has been strategizing and implementing effective solutions towards achieving certainty in the world of transfer pricing. Kunj has represented several clients in the DRP, CIT appeals, and ITAT proceedings, and also assisted a number of companies with MAPs under the tax treaties. Since the beginning of the Indian APA program, Kunj has worked closely with several companies on complex APAs, with a number of them already concluded. He's co-authored India's first comprehensive white paper on APAs. He's also authored several articles and has been a regular speaker at various global and domestic forums. Kunj holds an MBA from Sam Walton College of Business, USA, a CPA from the USA, a chartered accountant from India, and a Master of Commerce from MS University, India. He's also a member of the International Honor Society of Beta, Gamma, and Sigma. If you've noticed a common thread among the star speakers of this morning, all of them hold multiple degrees from several institutes. Trust me, just obtaining one CA degree from this institute was a nightmare for me. So a big hand for Kunj and team, please. Kunj, all yours.
Thanks a lot, Arun. Just to clarify, that resume does not mean I'm on market. Right. Thanks really, Arun, once again. Let me also introduce my co-speakers here. We've got my lovely friend and partner, Darpan, right sitting in the middle. Darpan is a young partner with us in Bombay, based in Bombay. Works with several of you. Many of you in this room would know him. Jitendra Jain, to the extreme left here, he's joined us from G about to... The G tag just doesn't go away, right? It's been over a year now. But the reason it doesn't go away is every day there is inputs that comes from his business knowledge that he has gained over years in dealing with G and the G matters. And that's been so valuable to us. So he's here and he'll join us with a lot of inputs and insights on what's happening in the digital world. Before we start this topic, there are three parts to the topic that I wanted to talk about, which is what we'll try to cover. We'll want to first establish what's the relevance of this. And I know we have already been talking about it. And just because everybody talks doesn't mean it is relevant. Sometimes it does feel like that. So many people talking, but why? What's the hard data behind it? And do we really feel it is relevant, right? So that's first part of it. What is big data? Why is it relevant? The second part of it is we go into, and that's what the paper also does, we go into the details of how you go about analyzing this. And we have put three aspects to analyzing it. There is nexus, value, and attribution. We'll walk you through that. And then we'll go through a little bit of journey of what's happening around the world in the digital taxation, especially when it comes to these digital companies or value created because of digitalization. Need not be only digital companies. So before I start getting into the topic itself, I want to play a short clip here. It's only an audio clip. Let's see how many of you can recognize what's being played. Could you please?
So how can I help you? Hi, I'm calling to book a women's haircut for a client. I'm looking for something on May 3rd. Sure, give me 1 second. Sure, what time are you looking for around? At 12 p.m. We do not have a 12 p.m. available. The closest we have to that is a 1:15. Do you have anything between 10 a.m. and 12 p.m.? Depending on what service she would like. What service is she looking for? Just a woman's haircut for now. Okay, we have a 10 o'clock. 10 a.m. is fine. Okay, what's her first name? The first name is Lisa. Okay, perfect. So I will see Lisa at 10 o'clock on May 3rd. Okay, great. Thanks. Great. Have a great day. Bye.
How many of you have seen this clip? There you go. A lot of familiar smiles were coming up, right? What's the relevance? This is Google's assistant, Google Assistant that they call, which is its AI system. What is AI? And I'm not going to get into what is AI and all that. All I wanted to say is AI is nothing, or it does not exist without data, without the power of big data that we're talking about. AI is fueled by the big data, tons and tons of big data, that is created on a daily basis. Somebody said that in a few years from now, every individual will be generating more than an MB of data every second. Every second. Can you imagine the amount of data that we're talking about? So we experimented a little bit. We have been running a transfer pricing lab and a few other things. And I had promised our innovation lab in Hyderabad that I'll bring them when I go to US. I went and got them Alexa, Echo Dot, on which Alexa sits. Just to clarify, which I didn't know, I thought that is Alexa. So I tried ordering Alexa on Amazon. You can't order Alexa on Amazon. Alexa is a software. Echo Dot is the hardware. And the team member set it up and shot a very quick 10-minute clip which they shared. I want to share that with you. Could you please play that one?
Alexa, what is transfer pricing?
In taxation and accounting, transfer pricing refers to the rules and methods for pricing transactions within and between enterprises under common ownership or control.
I don't think I could have given a better definition to this. Or many of us here would not have been able to, right? All of this is AI that we're talking about, fueled by big data. And this is what you see on the front end. There is a lot of usage of data at the back end as well that happens. And what do I mean by that? If you think about wind farms. Wind farms generate what? They generate electricity through wind. They generate a ton of data as well along with that. Every piece of machinery today that's functioning is digitally enabled, which is generating data, which in turn is further fueling the growth that we are talking about. So there is big data to my mind, and digital in itself is not, and I'm nobody here to validate what OECD thinks, but it's clearly not something that you can ring fence and say this is a separate digital economy. It's ingrained and integrated so much into the business. It flows like water. It flows like lifeblood inside the organizations, and that's what will come to be. In tomorrow's world, today, we can't live without cell phones, right? 20 years back, nobody could have imagined that. Tomorrow, we'll not live without AI, and it will become a second nature such that we can't even imagine. AI will make decisions for us, and that'll be based on all of this. And that's generating value. Now let's connect it back to what the session is all about. How do you put value on it? Where does it get generated? If I may just switch the slides, please. The slides. So I don't need to spend too much time on what is big data. Big data is nothing but, if you think about all this data multiplied exponentially, gathered in a structured manner across the world, that is big data. Very simplistically put. But it's tons and tons of data. So that's really, it's us, people like us. And even without, in a non-digital context also, this data does exist. It's only that it's not been captured. Now that everything has become digitalized, because we do everything through technology, we are able to capture this data into the system. Otherwise, if I went to my local grocery shop and I made some purchases, there is a behavior pattern that the shopkeeper is observing, and that is data. That's no different than the data that we are talking about here. It's just now there is a digital footprint because I ordered it online. The guy knows what I ordered, when I ordered, in what quantity I ordered, what's my preference, what time of the day I order it. All of that data is captured, and that multiplied exponentially becomes the big data that we are. And just look at the power of this big data. I'll give you some examples here. 300 billion per annum is the cost saving estimated in healthcare industry by use of data analytics. The amount of saving on insurance, records, timely getting the health care that you need to get, the medications getting in time, all of that put together, this is the estimate that you're talking about. 3 or 4 examples here. That's the other one. I'm not going to read through all of this and spend your time, but essentially what all of these examples exemplify and amplify is this is big, and it's here to stay, and it's going to be in every industry and every walk of life that we're talking about. So there is no separate digital versus. Now, just to think about digital in itself, why still everybody is talking about only digital, and everybody is talking about Amazon, Google, Netflix, Apple. These are, there's an acronym called FANG in the US that they refer to, F-A-A-N-G, which are these 5 companies that we're talking about. Digital companies in itself represented 7% of market cap, global market cap in 2007. By 2017, digital companies represent 54% of market cap, global market cap. That's why you have to focus on this. And why do you have to focus from tax perspective? The brick and mortar stores average ETR globally, this is data published by EU, is 23% roughly. Average ETR for digital companies is 9.5%. Effective tax of rate. You put all these data and statistics out there, everything starts making sense why this is really relevant, right? So now that we established it is really relevant, let's look at how do you really go about analyzing it. What are the value components? And I'm going to turn it over to Darpan here to walk us through those three different aspects that we've talked about: nexus, value, and attribution. Darpan, over to you.
Sure. Maybe I can stand as well.
Sure.
Just more convenient.
Up to you.
So we have an acronym that we want you to take back from this conversation. I mean, anybody who's following US tax knows it's all about acronyms in tax now. The tax world is all about acronyms. So here's one more for you. It's called NVA. And if you were catching what Kunj said, N stands for nexus, V stands for value, and A stands for attribution. So the interesting thing about this three alphabet acronym is, I think everybody understands N now. And N is being enforced. And what I mean by that, and then Jitendra is going to expand on that, N is essentially your SEP, which says that if you have a nexus with India in terms of the number of users, and if that number of users or the amount of revenue as a digital business you generate from India exceeds a certain threshold, then you have an SEP, which means you have a nexus with India from a digital economy taxation perspective. So Jitendra will expand on the N. I think the focus of my part of the conversation and the focus of the white paper is on the V and A. And is V and A one concept or is two separate concepts is the debate that's going to take place for the next 2 to 3 years as OECD works towards developing a consensus-based approach for taxation of the digital economy and taxation of digitalization in the traditional economy. I think OECD acknowledges that we need to find solutions which don't create a conflict or a discrimination between the digital and the traditional economy. So let's focus on V and A. So what does V mean? Kunj, and I think all of us acknowledge that like brand, like technology, like any other intangibles that a business may have, big data is another intangible that's going to create value for businesses. I think for digital economy, it's a given that big data is what drives value. I mean, we saw a statistic which said that 35% of the world's largest e-commerce platform, 35% of their sales are generated because of the reviews, the likes, the purchasing patterns that people input on that platform. So it's not just what is available on the platform for sale, it's actually through the recommendation engine that works on the big data and tells you what you may like to buy. And all of us experience that on a daily basis. And 35% of the sales are generated. So big data is generating 35% of the sale for an e-commerce platform. We spoke about another example which was there, which you would have caught on. Why restrict this to the digital economy? An aircraft engine generates data in 1 year. One aircraft engine generates as much data in 1 year, which is 3,000 times the data that is there in the entire US Congress library, which is supposed to be the largest library in the world, I believe. And that data is, people are working to figure out how to monetize that. Monetize to do predictive maintenance, monetize to improve utilization. All of these are going to create more income or may help you maintain your existing level of income, which means there is a tax or a corporate tax angle there. So the V stands for that. What is the value big data is creating? Now, the transfer pricing question then arises that, yes, you have a nexus, and nexus, I think Jitendra will expand on that. Once you've established a nexus for a digital business in India because of the SEP, the first question you have to answer is, what is the value attributable to the big data that you want to start talking about from a corporate tax perspective. So if you have a certain amount of profit that you generate from India, what Nexus says is that profit is taxable in India to the extent that it is attributable to India. That's what Section 9 says, and that's what the rules will evolve to say even when consensus arises. So the first step of the question is, what part of the global profit is attributable to big data? And that will be different for different businesses. Social media businesses will have a very different level of value attributable to big data than an e-commerce player, than a traditional businesses, but all of them have some profit which would need to be attributed to this new intangible. And it's the same for other intangibles. Brand doesn't contribute to the same value for all businesses in the same way. In some businesses, brand contributes to a much higher value. In some businesses, brand contributes to a much lower value. Same way with big data, it will contribute to a different level of value in different businesses. And that's the first step of the attribution analysis, which is the V, value of big data. The second step of the analysis, which this slide adheres to, is that once you've established, and let's take a simple example. Let's say for a social media company, based on valuation approaches or based on other industry information, one concludes that the value attributable to big data is 30% of your total profit. So 30% of the profit you generate is attributable to big data. The remaining 70% is attributable to routine functions and some of the other intangibles that you have. Those could be brand, those could be the technology, those could be the customer intangibles. But let's say 30% of the profit is attributable to this intangible. The next question is, what portion of that 30% is attributable to the user base in India? And you'll have to stay with me to appreciate the difference between value and attribution for a minute. So if you spend a minute on this slide, as Kun said, big data is the whole cycle which starts at one point by gathering your information and then putting it on the engine and creating insights from it. And what is that cycle? So if you, is everybody able to see most of this slide, or at least the center of the slide behind? Okay, so if you see this, if you see the cycle of generating big data, the cycle of generating value, it starts with capture, which essentially means capturing raw information of users on the platform. So which means your basic information about who you are, your age profile, your demographic profile, your behavior, and depending upon the social media platform you are, different type of raw information will be captured. And traditional businesses are also capturing user information. Wind energy was an example. The wind turbine is capturing some raw data of the behavior of the wind turbine, which is the first step of the big data cycle, which creates value. And then the next steps keep on adding more value to that raw data. You cleanse that data, which adds incremental value because you need the data to be qualitative and accurate. You combine that data with multiple sources because aggregation helps you create more value than just disparate sets of data. You curate that data, which means you organize that data in a form that can lend itself to further AI. Because AI, the fundamental premise of applying AI is that data should be in a form that AI can apply itself to, machine learning can apply itself to. And a lot of this is happening through a lot of menial effort of hundreds of people sitting and just curating data, removing stuff which is irrelevant or adding markers which make the data more relevant, which is the curation part. And then the last two parts, which is the highest value adding part, is the analysis of the curated data. And today the analysis is a combination of people and AI. And the future of analysis is, and that's what is predicted, and we'll see how far it takes us to get there. The future of analysis is that the analysis may be entirely done through artificial intelligence, today for which algorithms are being written, but tomorrow artificial intelligence through machine learning may be able to teach itself how to analyze the data. So over a period of time, the analysis part today, which is very human intensive, increasingly getting AI, could become entirely automated because of machine learning. And cloud computing is enabling that, and it's predicted, and let's see how fast we get there. Because some people who are skeptical say, this is great to talk about AI and ML, but do you really get valuable insights? Or do you still need human beings to sit on top of it and make good quality decisions of how to do the analysis, what should be the outcome of the analysis? So we'll see how human-driven analysis is and how automated it gets. The decisioning will probably for a very long time remain driven by people, because they will set the objectives for the entire cycle. They will set the objectives for the outcomes of this cycle and how to use this data, how to monetize this data, what kind of investments to be made. So why are we talking about this is to say that, and you go back to my example, that if you say that 30% of the profit of the business, digital business in this case, is attributable to big data, it's actually attributable to these steps in the big data life cycle. So you need a mechanism, an attribution mechanism, which is why I separated the value from the attribution, which says how much of that 30% is attributable to each of these 7 steps. And this is where the debate is happening. The debate is that should this 30% be attributed simply to the location from where you capture the raw data, which is actually the first step of the analysis, which is the capture, because the data is being captured of people in India, let's say in this example, or the value that is created through the cleansing, curating, combining, analyzing, and decision-making efforts, which may be happening through people, through AI, sitting in different parts of the world. I mean, you may have a captive center sitting in India, which is doing the high value-added steps of data of people sitting in Poland. So there may be consumers in Poland whose data analytics is being done by a back office center sitting in India. So the value on the raw data may actually be created in India because they are doing the analysis and decision-making part on how to monetize that data. And that's where the debate will be, and that's where we need to develop consensus, is that should that 30% be attributed entirely to the user base or the jurisdiction of the user base, or should that 30% need to be further allocated to these different steps, and where these different steps are being done, to the extent that they're being done by humans, it would be the SPFs or significant people functions associated with that location of the people. To the extent these steps are being done by platforms, it should be attributed to the IP owner of that platform, and so on and so forth. And which is where the friction between V and A, and a lot of countries will want to go, if they are at the source country, will want to say that the entire V is equal to A, whereas the residence countries will focus on transfer pricing principles and say, wait a minute, agreed, big data is an intangible, just like brand is, but is the entire return attributable to the brand allocable to the users of the brand? Or is some part of that return attributable to the SPFs associated with brand? And the same fundamental transfer pricing question arises here as well. And it doesn't stop here, because this is not the end of the big data lifecycle which creates value. If I just move forward, sorry. The value addition to the data doesn't stop in this cycle, because the other 3 elements that create further value is the sharing element, which is enabled by the platform, which is enabled by the manner in which it is designed. It's enabled by usage. The more data is used, the more its value is created. I mean, there are 2 points of view on this, that a lot of data is actually junk, but the analysis that is being done or the platforms that are being developed is to say that, can we use the historical data still to create value by combining it with current data, because there is linkage between behaviors. So even if your past behavior can be linked with your current behavior and some trend can be predicted, then you can potentially monetize even the old data. So the usage of old data and continued usage of old data creates further value. And more importantly, it's just one of the value drivers. And that, as transfer pricing professionals, we all recognize that, brand is not an isolated value driver to create value. Multiple value drivers, brand, platforms, big data, a new value driver, they will come together to create one value, and there will need to be an analysis at the first level of the V to say which part of the value is attributable to the brand, which part of the value is attributable to the platforms, which part of the value is attributable to big data, and then an attribution to say, yes, if this part of the value is attributable to big data, how do we allocate it between various steps of the big data life cycle? And I know this is a very busy slide, but the point of this slide was to highlight that and I think you will probably see more of this in the case studies that follow in the next session, which is focused on case studies. But let me talk about 2-3 things. And there is a principle here which I wanted to reinforce, which we've sort of articulated in the white paper, is that, if you take a simple vanilla case study, which is maybe not as relevant today because more and more stuff is being done in India, but if you had a situation where a social media platform's only presence in India was the user base and everything else was happening outside India. Clearly, the N says that the social media platform may have a SCP in India because of the user base, which is the nexus. We all recognize that user base and user participation creates value. So the V is also answered that some part of the profit generated by the social media platform is attributable to the user base and the user participation. The challenge would be what part of that value attributable to the user participation is attributable to the users in India. And that is the fundamental question which needs to be answered in a consensus, in a way that everybody has consensus around. So we've articulated a concept which needs to get applied based on the facts. But the concept is, if let's say in a simple case like this, the only nexus with India is the location of the user base, everything else is outside India, then that's the raw data part of the life cycle. So if I go back, it's the capture part. So what's happening from India is the capturing of the raw data. And I simplified it to say everything else is happening outside India. So one the basic transfer pricing principle that BEPS articulated was that find out where value is created, find out where the control over risk is, and find out where the Dempe functions for the intangibles are. So if we apply these basic principles and say that the only nexus to India is the raw data of the users, everything else is outside India, the question then is, out of the total profit attributable to big data, how much is attributable to raw data? And the feedback that we get from businesses when we speak to them, we've spoken to businesses, we've spoken to people who invest in these businesses, we've spoken to people who study these businesses and how they're evolving and how traditional businesses are now taking some of these learnings. They're saying that raw data is useless. A lot of people have a lot of raw data. It's only about 0.5% that actually goes through this cycle and creates value. So if raw data is useless and it is available for free, I mean, you don't get paid for submitting your user profile on LinkedIn, right? I mean, if it was valuable, you should probably ask LinkedIn to pay you for it. But the fact that you don't really have bargaining power to tell LinkedIn to pay you for being on LinkedIn, which means that you're really a cog in the wheel. I mean, you may be generating value for LinkedIn, but can you extract that value? Because you're raw user data for them. So that's one principle. But the interesting part is, it's not that businesses are only going to come to a source country and access raw data. Now they're doing many more activities in raw data. And let me give you some of the legal dimensions around it, which we've spoken about in the white paper. RBI is saying that if you're a digital platform, payments platform, you can no longer keep all your activities of the server collection of the digital data outside India. You have to locate it in India. That's now a regulation for payment gateways because they want to protect the data of Indian consumers in India. GDPR is asking EU citizens or allowing EU citizens to take back that data and will force digital businesses to give them more power over their data than they earlier had. We may have a new data privacy law in India which may give a different, similar rights to users and create more activities in India around user data. I mean, we all know that China doesn't allow data of its consumers to go outside, which means a lot of the value creating activities around the data may happen in the source country beyond just collection of user data. And that's going to make this attribution exercise more interesting as we go along. We put some of the legal dimensions here as questions, but the impact of those legal dimensions is really to say that the manner in which social businesses evolve and monetize data is going to be also impacted by the fact that laws will now require them to locate more of their value generating activities in the source country, which means if there are more value generating activities in the source country, then from a transfer pricing perspective, attribution of profits will only increase to those value generating activities. So let me then hand it over to Jitendra. So just to summarize, NVA, Nexus, Jitendra will expand on that. V is value. We all recognize that big data generates value. The transfer pricing principles that need to be applied to attribute that value to what is happening in the source country is something that we'll have to develop consensus on. Can we apply the 3 key principles that BEPS articulated? We think we can. And the good part about applying those principles in the long run is that you will then apply them consistently to traditional and digital businesses. So the food for thought was that let's evolve a consensus which allows us to develop a set of principles which apply consistently, because you may not know after 5 years, every airline may be the next Google, because that's what they're saying in the press. We want to be the next Google. Every brick and mortar company who's in the consumer business says, I want to be the next Amazon. So should we develop a set of rules which are exclusively applicable to 5 companies who are probably the only profitable companies in the digital businesses? Or should we develop a set of rules which are applicable to the broader traditional economy, because there may be very little difference after 10 years between the traditional business and a digital business. They may all look the same, but we'll see what happens. So,
Jitendra, if I may just add to that, it's not only digital businesses, right? It goes back to the same point. The digital aspect is going to be so ingrained in every business and
Absolutely.
various activities of business that it's hard to say I'm going to have one set of rules for digital and one set of rules for non-digital. The interplay is going to be so integrated that makes it difficult to even think about it that way.
Yep.
Okay, before I talk about Nexus, let me ask the questions. How many of you have, today's International Yoga Day, right? How many of you have done yoga ever in your life? How many of you can do Sirsasana, which is like your body is on your head, the inverted body? It's challenging, only one, okay, challenging, right? So what globally countries are trying to do is equally challenging. It's like doing Sirsasana. So, because the fundamentals of taxation are being challenged. Earlier, the nexus of taxation was the place of production, but now gradually that's being shifted to the place of consumption. That's what the countries are trying to do. This chart is very busy, and purposefully we have kept it busy just to show that there's so much action out there on digital economy. There is unilateral action trying to create nexus on the GST side, on VAT side, on income tax side. OECD is driving this project since 2013. EU has come into action as well. Within EU as well, different countries have different views. So, and we prepared this chart like few years back. If we have to prepare this chart now, we'll have to add few more bars, because even now Australia and New Zealand are planning to come out with something on digital economy. So talking about the OECD, in 2015, OECD came out with its first report where there was no conclusion on how to tax the digital economy, but yes, OECD explored certain options. They analyzed certain options on significant economic presence, withholding taxes, equalization levy, and interestingly, India went ahead and levied this concept. In 2018, the OECD came out with an interim report where again the key takeaway was that, look, there is no consensus globally on how to tax this digitalization of economy. So what the OECD has agreed is that by 2020 they will try to arrive at a consensus among close to 113 countries. So there is this close divide between 2 groups of countries. One group of countries, they believe that yes, data is valuable. The other believes that, look, the whole issue arising out of big data can be taken care of by the existing BEPS rule. And while OECD has discouraged interim measures, but what it has done is it has given some guidelines or framework for countries who want to implement interim measures. They need to follow those guidelines. As I mentioned, in parallel to OECD, even EU was talking about how to tax digital economy. So EU has introduced introduced the concept of digital PE, which is similar to significant economic presence. So what it says is, if there is a company which is providing services via digital mean in the EU, and if the turnover of that company from any EU member state is more than 7 million, or if the company's users in any of the EU member state is more than 100,000, or if the number of online contracts which are signed in the EU member state is more than 3,000, that company will create a digital PE in EU. So let me give a simple example. Everyone knows that Ola, Oyo, they are all planning to expand to other markets as well. So what this says is, let's say tomorrow, few years down the line, if Ola has more than 100,000 users in the EU, some portion of Ola's profit could be taxable in that member state. So it's like the flip of what we typically think of taxing, these digital companies in India. There could be a flip of those in EU as well. And one interesting thing in the EU digital economy paper is that it says The moment you talk about attributing profit for a digital service provider in the EU, profit split method is the default method, until unless the taxpayer can prove that there is another better method. So in a way, they have gone a step ahead in actually recommending a method to attribute profit for those kind of PEs. Similarly, while this all will require consensus through treaty obligation, because one member country in the EU cannot alone go and levy, lower the PE threshold. They have to negotiate so many treaties. So what the EU recommended is that meanwhile, what the countries can do is they can levy a 3% digital service tax, DST, which is basically like a turnover tax. And that will be levied for any worldwide group which has global revenue of more than 750 million euros, and if the revenue in the EU is in a particular member state is more than 50 million. As we speak, there is already a debate going on in the EU whether this threshold is too high, because there was an analysis which was done in the EU which says that based on this, only close to 150 digital companies will be taxed in the EU. So they're trying to lower the thresholds. And even within EU, there's a huge divide. On the one hand, there are countries like France, Italy, they're very vocal about implementing these sort of solutions. On the other hand, there are countries which are like in the Nordics, Sweden, they're very vocal about this is not the right solution for taxing digital economy, and rightly so, because Sweden is the hub of so many digital companies. India, when it comes to India, I think India has been the front runner in some of these aspects. Clearly, equalization levy, which was introduced in 2016, while the scope was very limited to advertising services, but at least India set the tone for other countries to follow similar proposals. I mean, Italy has also introduced similar concept. Spain is talking about similar concept as well. While the focus on equalization levy was only on advertising services, India went ahead and in the last budget, it introduced the concept of significant economic presence. The way that's worded, it can apply to multinationals selling even physical goods as well. So the point here is, just like the EU, it's the flip of EU, that if a particular company sells goods or services into India and generates revenue beyond a particular threshold, or it has users beyond a particular threshold, that company will create a PE in India. I mean, two things which is commendable here. One is that the government has decided that they will decide the threshold only after consultation with the stakeholders. That's one. And secondly, when this proposal was released, there was a clear statement in the explanatory memorandum that India won't go ahead and implement this unilaterally. They will implement this only if the other treaty partner agrees to it. Third development, which is again worth highlighting, is I think a lot of you must have heard of this Google ruling by the Bangalore Tribunal. I won't get into the specifics of the ruling, but very quickly. So as you know, Google is a reseller of AdWords program. So similarly, Google had another division which was providing IT-enabled services. And what that division did was they used to review the ads, and they also used to work on the development of the software, like product upgrades, product testing. The tax department argued that all these activities are connected with each other. And the fact that Google had a very successful commercial team in India, they have created a customer base in India, those in a way were akin to creating marketing intangibles. So the tax department attributed 50% of the profit to marketing intangibles, which allegedly was in India, and 50% to tech intangibles, which was in Ireland. So, and one thing which I want to highlight here is that on the one hand, while the tribunal has said that, upheld the application of profit split method, on the other hand, tribunal has referred the case back to the transfer pricing officer for the transfer pricing officer to determine whether really these activities led to creation of marketing intangibles. So I think to that extent, this ruling is very interesting. I mean, let's see what the high courts have to say on this. On this, I'll just like to pose one question to you, Kunj. I mean, one of the fact patterns in this Google ruling was that all of these activities were housed in one entity. So do you think the outcome would have been different if these were done in different entities, or do you still believe?
Well, we all know that there is already enough discussion and talk about anti-fragmentation.
Right.
So when you talk about whether it's in one entity versus separate entities, as long as it's one economic unit, right, if it kind of comes together as functioning as one economic unit, that these functions don't stand on their own, I think there is enough merit to look at it together. And in fact, I would commend here the openness of tax office, where we have had cases which have been and in one particular case, which has been in fact looked at in that manner, where multiple legal entities have been looked at together to arrive at the right transfer pricing application, where the operations were split between two legal entities, and we looked at it together to see how the transfer pricing should be worked out. So I don't see how that cannot extend to some of these situations.
Yep.
So
You wanna add?
the only observation here is that if you go to France and you see their Google ruling, I think they only had the ad reseller activity, and that was not sufficient for it to create a PE, which is what the French court held. So it's interesting that when you expand those activities to have people supporting you on both the software development and the ITS, that is sufficient to create a nexus which reselling of the AdWords was not sufficient to create. And I'm just placing it as a fact, not commenting on the correctness of the French ruling or otherwise, but just saying, I think courts also are evolving in the way that the tribunal has looked at it and said that let's look at it as one comprehensive FAR and see whether the right amount of profit is attributed to it. Because at the end of the day, whether you talk about a ruling for a MasterCard or any other digital player, where they have a P risk, or you talk about a Google, at the end of the day, the issue will always be what is being done in India. Is it routine or non-routine? Should we see it as one aggregated activity, and what is the profit attributable? Because at the end of the day, P or no P, that's the question that decides the amount of tax you pay, which is the important question. So,
well, in India's context, Jiten, the other part is, if we go back to your life cycle, the value chain of big data, which has various different activities starting from collection of data and then cleaning and curation and analytics, we have enough companies here who do analytics as a back office services, right? And that's just one part of that activity which is happening here, but the data is generated across the world. And where do they sit in the value chain is another example which could also be looked at and see, are we adding that value in a different manner?
Yep. So I think the message here is, if data really plays a big role in your value chain, I think that's one area where there will be a lot of focus in the future, both from PE, attribution and transfer pricing perspective. So we really need to do a very robust value chain analysis, and as Darpan mentioned, to see how data plays a role in the entire value chain. Very quickly, I think UK similar development. Just one point here. UK again went ahead and categorically mentioned that profit split method will be the method to attribute value to user participation. So clearly, a lot of action happening globally. So do keep an eye on this, and if your company depends on data to a minor extent or a huge extent, I think this is one area where you need to really do a deep dive. So we can now get into the other
There are a few questions. Why don't you just click that? Okay. There are a few questions which we thought are coming out of this, which would be good to deliberate here and share our thoughts, how it's going. Please feel free to chime in as well, because nobody has a decisive and a conclusive answer on these things. But let me start with the first question. Attributing profits to big data, should there be different rules for digital and traditional business? Darpan.
So I call the equalization levy an interim solution, and what everybody else is talking about is a long-term solution as an interim solution for the digital businesses, because a long-term solution has necessarily to be an application of rules which apply consistently to both digital and traditional businesses, because otherwise you're discriminating. In this case, you'll be discriminating against the digital businesses, and then you'll in the future be discriminating against traditional businesses who want to become digital and derive value from digital. So I think in the long run, my view is that we should have a same set of rules. How we get there is the challenge, right? So will some countries do a two-step approach and say, okay, I'll do equalization levy for a couple of years, then I will do this SEP, full attribution of the value attributable to big data to the user base, not the user participation in the big data activities as per the life cycle. And then I'll wait for some broader consensus to emerge and then, integrate it. I wonder.
All the actions that we have seen we've seen equalization levy, which actually goes to saying what is attributable, how much value I think I should have 6%, here, and therefore 6%, 3%. These are the percentages that are out there. But then when you look at SEP doesn't get into attribution so far. SEP only talks about you have something to be taxed in the country.
Just the nexus part.
Just the nexus part, and that's where the attribution becomes such a key element, which hopefully, and I'm not going to put you on spot here, Jeff, but hopefully OECD will come out with something that will guide us all.
Yeah, there's another issue that hasn't been mentioned yet that's, I think, going to come out at some point in all of this as another thing to be wrestled with, which is characterization of something as a royalty for a license of intellectual property versus service fee payment, because at least under the OECD model, Article 12 allows withholding tax on a royalty, or may allow withholding tax on a royalty. So that's quite apart from your nexus question about PE, right? That's just a source. So you got a character question: do you have a royalty? Then source: is it sourced in the country where the customers are, et cetera. So, and then if there's a withholding tax, you have to then avoid double taxing. You don't want to tax it again under some other analysis. So that's another sort of feature of the landscape here. And yeah, the OECD work on digital is going to have to wrestle with all these issues. That's why earlier in the morning I suggested the task force on the digital economy will probably delegate some of its work to working parties 1 and 6 to sort of think through all the implications of what they're talking about. And it could become more complicated before it gets any simpler.
And no, that's a very fair point, and the characterization issue is absolutely very key, because then it comes down to how do you tax it. So you identify it, you got the value that's attributed, how do you tax it? What worries me even further is you do all of this and then it changes. And it changes so quickly because the businesses are changing so quickly that the value that got created today here will sit somewhere else tomorrow. And that's happening as we speak, right? So if you just go to the next question. Sorry, go ahead.
One point here, while we are all talking about attributing profits because we are focusing on those big 4 or 5 big companies, there are a lot of digital companies out there who have never made profit. Truecaller, I mean, it's yet to make profit, but 65% of the users are in India. So we know one need to bear in mind that yes, if you're talking about attributing profit to the user in India, there could be a lot of situations where you'll have losses to be attributable, and we have seen, there is generally a reluctance by the tech authorities globally when it comes to attributing losses to their particular countries.
I agree. Profit has to include loss, and how do you go about doing that? Because those years have already gone, somebody has already invested, and that has to be taken into account for the future years as you are determining what value and how the value really shapes up. So funding, somebody who's developed it, all of that has to be taken into consideration. The other aspect, just not necessarily connected, but if you flip this, right, that India is big on exports. We access the markets outside India as well significantly, and not in the digital world, but otherwise. What about the value to that market? We are happy doing distributor returns and market service returns in those countries, and these companies are deriving value by accessing those markets. 100% of the sales, or near 100% of the sales, is happening in those countries. And that's not only true for India, there are many countries, many other companies also which have the same thing. This goes back to the life cycle of the data, right? Is raw data has limited value or no value? What do you think?
So that's what businesses are saying, and what they're saying is that, if I don't apply the algorithm, if I don't apply the machine learning, if I don't aggregate it, if I don't combine it, if I don't build the platform around it, raw data is so easily available. And the interesting dimension, one of the policy makers, not from the tax perspective said, is maybe the solution to this is monetizing the raw data by allowing people to charge for being on a platform. And I said, what do you mean by that? And he said, you're looking at a tax question, and think about it this way, that today I don't get paid for signing up to a social media platform because I don't have bargaining power, and I need them more than they need me, maybe. Even as a group of consumers, I can't really charge for signing up. But what if data was like oil? And I think Arun started with that, right? Yeah. Somebody said data is like oil, but it has no value because oil is a captive resource, limited, and will run out at some point of time. But data, the creators of data don't have any control over how they can charge for it. I mean, it's us. So the point is that if that has no value today, and what GDPR is doing is bringing more power to the users, then can users say that tomorrow you need to pay me for signing up to LinkedIn or the social media platform?
I can choose whom I make it available to.
And Australia is doing that. So Australia's budget proposals 2018 say that social media companies or companies which use user data will need to create a one version of the user data, and the user can choose, who can use this data. It's like a do not disturb thing that we have on our phones now, right? We get irritated about, and so we choose who cannot call us. So similarly, users will be able to choose who can use their user data, and that includes likes, preferences, which photos you posted and all that. And if somebody wants to use it, you may turn around and say that, I know it's valuable, do you pay me for it? And that solves the tax question. Because if I get paid for my data being used, then I will have to pay tax based on the rules that apply to me, and that's the attribution. But one point of view is, and that's what businesses are saying and investors are saying, that otherwise raw data has no value. And I know that
Mr. Varshney is here. Sir, please.
See, I don't agree with this statement that raw data has limited or no value. And you are basing your statement on the basis that if I sign up for WhatsApp, I don't have to pay any money. And that is for the reason that I am getting some service in return.
Free.
And that is also free of cost. So it doesn't mean that, my data, raw data doesn't have any value to WhatsApp, and what WhatsApp is giving to me in return has no value to me. That is not correct, because it is reciprocal. It's like a barter.
It's a barter.
Yeah, so it's like a barter. The question you don't have to see from my angle, you see from WhatsApp angle. Now WhatsApp has collected data of all Indians. Now if a political party here for 2019 election, if I am with a political party, I go to WhatsApp, I say this is raw data, it has no value, give it to me. Will they give it to me without cost? Without cleaning, without analytic, I will do it. I have IIT engineers with me. I am going to do the cleaning, I am going to do analytical. WhatsApp is not going to give it to me free of cost. So raw data has a value.
So there is very, very fair point, very fair point. There is value to raw data. The question is, it's in what context we are talking about.
Yeah.
When Microsoft acquired LinkedIn, the valuation and PPA done for LinkedIn, they have put value to the user data in its books of about 3-some billion out of the 19 billion or 26 billion that they paid for LinkedIn. Facebook, if you go to their balance sheet, acquired users is shown as $2 billion as the value. So it's a question of what value, limited value versus, and you're right, sir, you can do more analysis. The value that WhatsApp has and why it would not give it to you for free is that it has put in the efforts to collect that. It has done what it has done to collect that data, which has not come free. And that's really the point. Just like you said, there was a barter system. They gave something free to collect that data, and there is a cost to that.
And just to add to this, the switching cost from these apps to another app is free, right? I can switch to another app if I find better features. So if you see WhatsApp's current version is 2.18.41. So which means there's a constant investment in technology to make sure that people are hooked to that particular social media site or that particular app. So of course there is huge value in the technology as well.
And that's why you've got to look at the whole cycle and see where the value resides. How do you attribute the entire value of the data again among the cycle?
That's all right. You can't say that all value lies here. There is the other part and
absolutely, sir.
Part.
That's all the
but you also can't say that it has no value or insignificant value.
But you'll be surprised, sir, that and not just counter this. You'll be surprised. We had chats with several business owners. People who are in the business of doing data analytics, not tax people, people who do business analytics, raw data analytics, they are the ones who say data is just available. And this is reality.
And there are companies which are in the business of buying and selling raw data, which they call information data brokers. And they don't make exponential return just because they have raw data. And that, we were evaluating to arrive at the value, and we've given this example in a white paper, that to arrive at the value of the raw data, you can actually look at the returns of these data brokers and see what returns they're generating, which are in the business of collecting and selling raw data. But that's just a reference point.
So just Jeff, you wanted to say? Sorry.
Just a very short comment. This barter transaction of giving your information about yourself and getting the service for free, I think everybody recognizes that's happening. But from an income tax point of view, there's no realization event there, right? You don't have something, either money or something equivalent to money that's being exchanged. So you can't measure a profit from that transaction alone. I think it's important to remember in discussing this value chain analysis that at the end of the day, for income tax, we need to still have a realization event and a measurable profit.
Thanks, Jeff.
Sure, we have only, Amay has been flashing there. We have 5 minutes.
I think let's stop here.
Just top of this question, consensus-based.
And I think we've driven that point hard, right? So, the whole idea is interim, long term. Let's move to the long term. One of the feedbacks that we're getting, especially for countries like India, where the digital economy is still thriving, we need to still create the right kind of jobs in the digital economy. We need to create the data analytics jobs. We need to create the machine learning jobs. Is that if the tax system can align with the fairness of taxing this in a way that doesn't create double taxation, which allows us to make further investments in this ecosystems, allows us to create the talent that we need to become what China has become in the last couple of years, then for countries like India, which want to play a big role in adding value to this ecosystem, consensus-based approach.
We don't only have users. We have people who do the analytics, we have people who do all cycle of this, and there is a lot of value. In fact, if you start looking at it that way, we could be looking at attributing large part of that value here.
In fact, a lot of the Indian companies and startup now, they are going outside. So it could be a flip scenario as well.
Yeah. So I think that's the thought we want to leave this audience with, that I think it's in the best interest of both tax policy and business stakeholders that we have a consensus-based approach to promote the growth of what we think from an India perspective is still a fledgling ecosystem. And maybe that's the food for thought.
Well, we can open it for 5 minutes for question answers. Okay. Yes, sir.
Can I ask a question? I'm basically an economist.
Yes, sir.
And essentially, you can only have a value if there's somebody who's prepared to pay for it. And the question therefore arises is, what is important, the market or the supplier? If you haven't got any market, you've got a lot of supply and no market, what's the price? Zero. On the other hand, if you have a lot of people who want to buy and you don't have a supply, it's millions. So the question really is, we are talking about these, we're looking at it more from a technical point of view. The real problem which keeps arising, and when you look at the tax issue, the countries which are providing the supply, they say, look, we developed this, and therefore they are entitled to a certain amount. But the fact really is, they don't have the markets which something like India can offer. Now, who deserves the value from a tax point of view? What is your view?
Sir, clearly where the value is realized from that is where you want to look for. I totally concur with whatever you're saying here. My limited point here would be, go back to example on Facebook. The largest user base of Facebook is India. But the value that Facebook generates, the revenue that Facebook generates maximum is from Europe and US customer base, not Indian customer base. So what contributes to Facebook's value? I agree that, but even in Europe, it's the people, the market which delivers the value, yes, not yes, the product itself. Well, but the people would not stay if you don't have the products to sell. But the thing is this, it's both ways. I would not go on WhatsApp. WhatsApp would not have become this popular. Before WhatsApp, we had something that, before Facebook, there was an Orkut that came, which came and gone, right? There's a number of these things that came and went. But certain things have stayed and have become what they've become.
But the thing is at the end of the day, it's the market which decides.
Yes.
And the fact really is, we keep forgetting that point. I mean, the thing is, this obviously depends on which side the bread is buttered. The countries which provide the supply, they say, look, we have developed, we have invested, we created this product, and we have determined the market that was existing somewhere else. On the other hand, the other countries say, look, okay, we have developed the market, we have a lot of people, but if they are not educated, if they don't have the money, it is in fact demand without a supply, without any value.
Yep.
So it has to be in fact demand backed by money. And for that, you need education. We have provided the infrastructure. All that is what the countries are saying. I'm looking at it from a macro point of view.
Sure.
So if you talk about what we are talking about is significant economic presence or equalization levy, a country like India and the other countries which don't have the market need that because they may have the product and nobody to buy. So I would like your views. Which side should we look at? The right, which is the buttered side?
I think we've had this interesting conversation that Amay and Arun had started a year ago on whether we should add an M to the FAR. which is the farm analysis. Should the
Mr. Ranjan spoke about it.
Yeah, Mr. Ranjan spoke about it, and
as
that,
well,
that
yes.
hits at what you said. And my humble and maybe not so evolved view on this is that I think we then need to agree whether corporate tax or destination-based indirect taxes are a better way to tax some businesses. Because at the end of the day, as an economist, I think for the government, what should matter is the tax, the fiscal contribution of that business to his country. And corporate tax is just one of that. It's just that, are we going to rewrite the corporate tax rules so fundamentally that they start discriminating between some businesses which create disproportionate value from the market versus some businesses which create a very different level of value from the market, and that's where it gets subjective. So if you asked me, not as a transfer pricing practitioner, but as a person who is looking at this debate as a society, I think society needs to answer that question and say that maybe we need to do more of destination-based consumption tax, which is like a GST or any indirect tax. Equalization levy is nothing different, the same thing. Maybe that's a better solution for a country, for a society to get certainty on how some of these businesses will contribute to the development of that country. I think if you take the debate out of that context and say in corporate tax, what is the right approach to this, then I think we're trying to create, I mean, my humble view is that we're trying to create a set of rules which may not be sustainable in the long run, and which may be what we're hearing from businesses are not even aligned with where value is created. That's really the, maybe a incomplete point of view to what you asked.
The problem with destination tax really is it ends up by the customer paying rather than the person who is making the money paying. And that is where the difficulty.
Or the other solution could be to charge a market access fee. I mean,
We'll have to bring the session to a close, but thank you so much
Thank you.
for a patient hearing. Thanks so much. Thanks a lot, guys.
Thanks.